Hi everyone, it's Jack back with another video, and today I'm going to be talking about Sherwin-Williams, what many people would classify as a boring company. It deals in paint and coatings. Pretty much any application you can imagine for paint and coatings, Sherwin-Williams has a solution for that. It's a $60 billion company, so one of the largest coatings companies in the world. Has a 1% dividend yield. However, while that is a relatively low amount, it's increased this dividend for 44 years in a row, so it is a dividend aristocrat, almost a dividend king. It's soundly outperformed the market in the last few years, hence why the yield is so low. However, this year, or in the past 365 days, it's down almost 20%, and the majority of that decrease came when the stock went down 10% the other day when it released its earnings. So I want to analyse these earnings. It's still trading for a reasonably high PE, as it often does. I want to analyse these earnings, see what we think of them, see if we think this is going to be a buy, sell or hold for the long term. First of all, let's get into those Q4 results. Sales up 9.8% to 5.2 billion, primarily due to pricing. They had basically flat volume and some low single-digit contributions from acquisitions, and it was offset by financial exchange headwinds, as we've seen across many businesses. Gross profit up 18.8%, strong increase. Gross margin expanded by 320 basis points. That's essentially driven by sales growth and pricing. Modest sequential decline in the raw material cost quarter over quarter, but nevertheless a decent result on sales and a very good result on gross profit in my opinion. Reported earnings per share up 28.7% and on an adjusted basis up 41%. EBITDA of 40.9%. Again, as a percentage of sales, that's a 320 basis points increase, and net operating cash is actually up 230%, admittedly off relatively weak comparisons on the year prior, but still all of these look pretty good in my opinion. The real lagger in terms of business segments was the Consumer Brands Group, with sales down 2.4%, primarily due to high single-digit volume decline and a low single-digit headwind from FX. They got a bit of an increase from pricing, but still volume down, and that resulted in a 2.4% sales decrease. And this is mainly due to the inherent cyclicality of consumer paints, because the majority of them are used in houses. The primary time to redecorate is when you're buying a house for the first time, and the housing market is pretty weak at the minute due to interest rate rises around the world, not just in the major markets. North America and Europe, Africa and the Middle East were up low single digits, primarily due to price increases. Asia down double digits, which drive the business down. I don't think this is anything to worry about in the medium to long term. In the short term, we could see a bit more pain, as in if interest rate rises are going to increase, which they are looking like doing in many markets. This could perhaps worsen in the next few quarters. However, overall, I think nothing to worry about in the medium to long term. Overall, on a full year basis, sales were up 11.1% to 22.15 billion, mainly due to price increases driven by strength in professional, architectural and North American industrial end markets, but this is mainly due to price increases. Gross profit increased 9.2%, even though gross margin was down 70 basis points, but that was mainly front-loaded at the start of the year. By the end of the year, as we saw in the most recent quarter, gross margin has largely recovered. Reported earnings per share up 10.6% and adjusted earnings per share up 7.1%. Overall, I think this is a reasonably strong year for the business. However, the guidance is really where the worries came in. For the first quarter of 2023, the guidance for sales is flat to up mid-single digit percentage, so call that 5%. That's a significant decline from the most recent quarter, which was around 9%. Slightly worrying. What's even more worrying is the full year guidance. Sales flat to down mid-single digit percentage again, so obviously they're going to see some recovery later on in the year, because they think the business segments, consumer brands, they reckon will be down low double digit to mid-teens percentage. That is quite significant. It is a large percentage of the business. Other business groups are going to be less harmfully affected, but still down in the 5 to 10% range. This is certainly worrying for this business. Price increases can only go so far. They're expecting 800 million of capex, 250 million for a new R&D facility. Overall, I think cash flow is going to be hurt a little bit and sales are going to be hurt significantly. So the business and the price, most importantly, is going to come under a bit of stress in 2023, in my opinion, making it perhaps not the best stock to own for 2023, but a buying opportunity could certainly arise in this year. The reasons they are given for this guidance are slowing existing home sales. That's going to impact negatively on their residential sales significantly. Impact of inflation on DIY, higher inflation and higher interest rates mean less money in the average person's pocket, less likely to embark on DIY projects that are not necessarily essential, and they believe that industrial weakness in North America, Europe and Asia is going to continue throughout the rest of the year. And the reason I think this could be a significant problem for the business's price is because it is already trading at price to cash flows significantly above its 5-year average. 5-year average in the green of just shy of 25, current value of 40.6. That's a significant overvaluation in my opinion. Price free cash flow of 40 is way higher than I would be likely to pay for even the current sales, never mind what it's going to do next year. I can see a big reversion to the mean for this company, and I can see the losses continuing. These sort of numbers that we're seeing in 2019, 2020 are where we should be aiming, and that could be a potential 50% decline from where the stock is right now. Of course, cash flow for this business has been relatively depressed, but the stock price has not followed, which is a bit of a mispricing in my opinion, and I can see this business being affected negatively. On a price earnings ratio, it is underneath the 5-year average, but really for Dividend Aristocrats, price free cash flow is what we should be looking at, because that is what affects the dividend being paid overall. The saving grace for this business could be its resiliency and its Dividend Aristocrat status. Payout ratio of just shy of 29% is reasonably low, so cash flow can take a bit of a hit and the dividend is completely safe. It's a 5-year growth rate of 16%, 44 years of dividend growth, and while that payment of around 1% isn't spectacular by any means, I think the resiliency of this business means, and its status as Dividend Aristocrat, very rarely trades not a premium to the S&P 500, so I believe it'll probably be okay and maintain its price in the short to medium term, but I definitely think it'll come under a bit more pressure than it already has done. I think we could be seeing it testing its 52-week low very soon. All in all, I think this is an excellent business that is very resilient, will continue to pay its dividend, continue to return cash to shareholders in a positive way, and probably beat the market over the longer term. However, I just think the price is a little inflated right now. Over the medium to long term, I'd be more than happy to own this business, but I want to own it and be buying it at the right price, and right now I just don't think it's anywhere near the right price. I'd be much happier seeing it in the $150 range. If it doesn't get to that, so be it. I won't be owning this business. If it gets to relatively cheap prices where we can value it on a DCF basis and sensibly, which I haven't even included in this video because the numbers are so ridiculous, then maybe we'll talk about this business. But for now, I can't really be investing in this business for the medium to long term at these sort of prices. Of course, this is just my opinion. You should do your own research and due diligence. I'm not a financial advisor, so you should not take this as financial advice. Let me know in the comments what you think of Sherwin-Williams. Let me know what you think of other Dividend Aristocrats in this space, which you think are better or worse. Let me know in the comments below. I'll see you again next time.